welcome to another episode of the Oz DeFi Community Podcast. Shahirah here, co-founder of Finch and venture partner at Scarlata Ventures. And joining me today is the wonderful Sidney Powell, CEO and co-founder of on-chain capital markets, Maple Finance. Welcome, Sidney.
Hey, Shahirah. Glad to be here. Thanks for having me.
Thank you so much for joining us. I always love the opportunity to dive into areas of DeFi that's not part of my day-to-day. So I'm really keen to kick us off. I do love to start these conversations with, I guess, a bit of an intro on your background. You're obviously a tradfi guy, career in banking and corporate finance. Tell us about your journey into Web3 and maybe what your aha moment was in pursuing this path.
Yeah, sure. So as you mentioned, I was a tradfi guy. So my background was in banking. So I used to work at NAB actually, and I was doing debt capital markets work, which meant securitizations. So I was helping, in effect, that was helping lending companies to borrow so that they could give loans out to their customers. So it was quite complex, but I really enjoyed working with the entrepreneurial set of clients that part of the business had. And then eventually I had the opportunity to go from being on the deal side, so doing deals as part of the bank, to being at a company that did lending as a business and actually seeing what was involved there. And when you go from being on the deal side to actually being embedded in a business and doing that, you can see that it's actually a lot wider, the set of things that you need to worry about and manage. And that was what I found working at that company. And so I would have to deal with lawyers, with the tech systems, pulling together reporting, trustees, trust managers. But altogether, I found that you have, 6 or 7 different parties that you have to pay fees to and who you have to coordinate with to borrow and to operate a lending company. And so this was 2017, 2018. And that was when I started hearing about cryptocurrency. But when I was in the bank and hearing about Bitcoin earlier on, I, like everyone else who worked at the bank, just assumed it was a scam. Mm-hmm. And I wish I'd taken some people's advice earlier on to buy it. But it was really when I started learning about the concept of... Yeah, exactly. But it was really when I started learning about the concept of smart contracts that got me interested, because the initial value proposition as I saw it was that I could automate all of the third parties that I had to pay fees to and just program that as code and save all of that margin. So I saw an opportunity to have a much more profitable, efficient business. And that was it. So I went down the rabbit hole in 2018. I was reading all these white papers and I was conceptualizing, could you do tokenized securitization on chain? And then in 2019 started to write a white paper about this. Mm-hmm. And then me and my co-founder, who, we worked together at that lending business, we then started conceptualizing the idea that would become Maple eventually. But it was just very, it was in fits and starts early on. So it was trying to write a white paper, trying to meet software engineers, trying to get into the space. And, it was just a long journey to kind of get here. And then by the end of 2020, DeFi summer had rolled around. And you just started to have an ecosystem, and people suddenly believe that these could be, viable businesses and viable protocols. And that's when we quit and went full time on Maple.
Excellent. I love that ability to have been in a business and identified so many inefficiencies and so many overheads associated with doing something that now feels very seamless and effortless through the smart contract mechanism. So tell us what Maple Finance maybe started out as in 2021. It's crazy to think you've only been around for a few years, just given the incredible work, and the journey that it's been for you to date. And I guess as part of that, I'd love to hear what the last few years has actually been like for you. I understand, at the peak of Maple, you were lending somewhere, around $2 billion in loans, which is an enormous amount. And then, of course, there was surviving the fallout of last year with the FTX and the like. So take us on that journey, Sid.
Yeah, there's a lot to unpack in there. But how Maple started was this concept of doing tokenized bonds on chain. And so that, that was a nod back to my my time in banking doing securitization. But we
Mm.
realized that we didn't have a complete product because there were no loans that you could actually, tokenize and turn into bonds. And so the product evolved then where early 2020 uh, we were trying to write some peer-to-peer loans, but we found it's very difficult because you're writing, five or $10,000 loans with your own money to potentially anonymous people, and you're very unsure whether they're going to pay back. And we're thinking, this is going to be incredibly hard to even do $200,000 of loans, let alone 2 million. And how is this possibly going to scale? And so I would read all these, white paper analyses of like Lending Club, people doing analysis of whether Lending Club ever actually made money for lenders. And the short answer was it didn't really. And so then we kind of merged the original concept, which was let's have pools of loans that get sort of tranched out, with the idea of let's vertically integrate and do, have the lending occur on the platform. And that then became the package that eventually launched in May of 2021. And so from there, it was like this roller coaster ride where the volumes grew slowly at first, but then by the end of 2021, we had 500 million in assets deposited across the pools. And Maple's model was to have outsourced underwriters. So it was like money would go into a pool, be held by a smart contract, and then you'd have teams of underwriters, which we call delegates, who would be third parties who use us as like infrastructure and software to run a lending business, with the idea being that it would be more profitable and easier to aggregate capital. So a more profitable way to do lending by using the blockchain. And as we went through 2021 and 2022, we, as you said, hit about 2 billion in loans done. And at our peak, we had about 1 billion in deposits in the protocol. But this was fueled, like this was fueled by macro conditions where you had a lot of easy money, and so people were chasing yields, and so that meant money was getting pushed into protocols and into DeFi, and people were chasing very high yields that were often driven by these token like liquidity mining incentives. But people weren't really adjusting for risk, and so the bread and butter, and I'll use Maple collectively, including the delegates who do the underwriting, but the loans on Maple were going to market makers and market neutral funds. So these firms are not gambling. It's not lending for gambling. They are being lent to so that they can provide execution. So in Australia, you might have somebody who trades on BTC markets, or maybe they're trading on Binance or Coinbase. But when they're executing a trade, the other side of that is generally going to be provided by a market maker, and they were going to borrow from a platform like Maple, or they were going to borrow from one of the centralized lenders. And so they're just providing a service, and they're getting paid to provide that liquidity on exchanges. But what happened is, as we went through 2022, beginning in May was like the high point, and then you have this collapse. So you had the collapse of Luna, and then that triggered the collapse of Celcius, which was attributed to improperly hedged positions in DeFi and some losses to hacks, but this concept of impermanent loss. Mm-hmm. And then you had this kind of contagion effects rippling throughout DeFi, where then you had in June 3AC collapsed, and that then left a dent in Genesis's balance sheet, who was one of the dominant centralized lenders. And so you just had this ripple-on effect where things just kind of went from bad to worse. Now, Maple's loan book actually held up surprisingly well, given that the product was uncollateralized loans. So a lot of people would have said, well, that type of portfolio should just be wiped out.
Sure.
And that portfolio was yielding, like north of 10% on the loans. But interestingly, when you include all of the loans that were written, so about 2 billion, the total cumulative defaults were about 2 borrowers, about 45 million, which was effectively a loss rate of about 2.1%, which is actually pretty good. Like for uncollateralized lending, given what happened in the space, was actually a very good result, and outperformed all of its CeFi competitors, who are now all in Chapter 11 bankruptcy.
What do you attribute that to?
Paradoxically, the fact that it was mostly a portfolio of uncollateralized loans meant that it had to, the delegates who were underwriting the loans had to be more careful anyway, because they knew that if a borrower were to default, they would lose, like it's close to 100% wipeout. in loss given default. And we were much smaller, so we had to be much more careful because we weren't in the event of a default, we weren't going to carry as much weight as our competitors, and we were uncollateralized rather than collateralized. But it was also like just prudent risk management. So 3AC applied to borrow from Maple and was rejected because of the poor quality of their balance sheet, and their financials didn't add up. Their corporate structure was also very convoluted. Alameda was borrowing and then wound down months before they collapsed because the weakening of their balance sheet was observed. And anyway, but didn't totally escape. So had a couple of borrowers default. And what was interesting was one of the things that people look at is, are DeFi loans going to be upheld by courts? Like, are these valid? And what we found was, well, it's a valid legal contract, and then the loan just settles on chain. So it's like, if I write you a loan, Shahirah, and we sign a legal contract together, and then I just pay you cash, that's still a valid loan. And so the way to view loans in DeFi are that they are still valid. Like, there's a valid legal obligation. It's just that the money moves hands on the blockchain. And so the court multiple times upheld the validity of these loans. And indeed, the two borrowers who defaulted are still going through proceedings where the blockchain DeFi loans that they took are being treated as valid alongside the other loans that they took. But anyway, let's so we flash forward, then FTX happens, and suddenly people's risk, the level of risk adjustment people are applying to yields in the space increases dramatically. And at the same time, you have the macro event of treasury yields expanding, so quantitative tightening. And this meant that money got sucked out of risk on assets, of which DeFi was treated as one, and went back into, traditional finance or tradfi instruments like treasuries, government bonds. And this is the same in stocks. Like, stock valuations decline. It's just that it's more pronounced in DeFi and in crypto because it's a higher beta asset class. And so anyway, it brings us forward to today, and Maple's core DNA remains, capital market on chain. And the core thesis is that doing this running lending business on chain ultimately leads to lower costs, which makes your business more profitable over time. But tactically, what we've had to do is adjust the types of products that are offered. So what we launched and what we started doing the first loans out of yesterday is this cash management pool, which is lending to an SPV. So it's bankruptcy remote. It doesn't have other commingled obligations and debts. It borrows through Maple, and it buys T-bills, and it pledges those as collateral through a qualified custodian. And what that allows us to do as a service is to bring on-chain, low-risk, highly liquid yields, and effectively a kind of substitute banking service or substitute cash management service where you can put your stable coins as a crypto company. So a lot of crypto startups cannot get banking services in certain markets. Like, they're just denied the services. So they'll say they're a software company, but if a bank finds out they're working in crypto, they'll get debanked. And so they need a safe place to put their funds. And that's what we're trying to offer here, is because effectively their deposits are one-to-one backed by short-dated treasuries. How I actually think this can expand, though, is like, let's then turn that weakness into an advantage and create tokenized repo on chain. So that's what we're trying to do here. Now, traditional finance repo only settles at the end of day, so kind of low, what would you call that? Like high latency. And then it only trades during business hours. So low uptime overall. By putting this on chain, you can effectively have a deposit token that is kind of like tokenized repo. It's fully backed with treasury instrument. It could trade 24/7 among KYC'd counterparties, and it could settle in minutes. So now I've got a product that's actually better than anything you could get in tradfi. And so what we want to do is expand that and have that ideally treated as collateral on centralized and decentralized exchanges. Allow, let's say, a sophisticated treasury manager has $50 million that they want to earn interest on. Well, on a Friday night, they could buy that token, hold it over the weekend, collect the interest, and then sell it or liquidate it on a Monday. And so that's the kind of market that I see this evolving into. But anyway, that's a low risk product. And then the other one, that because we try and treat it like a portfolio approach, so that product is going to do fine as long as treasury rates remain elevated and people are pretty risk off. The other one is this concept of Maple Prime, which would be our loans, held in smart contracts on chain, so totally visible and transparent, which is one of the things that that really plagues CeFi. And we could connect those smart contract loans with a qualified custodian so that we could over collateralize them with assets on other chains like Bitcoin. And so that gives us, again, a low risk sort of over collateralized product that people can't get in TradFi. So that's kind of how we're thinking about positioning ourselves now for the remainder of this year.
That was excellent. And I think just if I were to zoom out a little bit and understand how, and I guess underpinning your choice of using sort of T-bills is this idea of real world tokenization. So perhaps you can explain that process, and if in fact the tokenization of those assets, what does that process entail? Is that part of it happening on chain?
Yes. So there's two ways you can tokenize assets. We've adopted a kind of leaner one. So let's look at both of them. The first one is you don't tokenize the asset itself. You create an obligation against it and you tokenize that. So in Maple's case, there's always loans that are tokenized. So it's like if let's say you start a business and you borrow through a Maple pool, well, that loan is tokenized. So your interest rate, the duration of the loan, how often you have to pay it, all that is tokenized. And it effectively represents a digital version of like a loan term sheet and a legal agreement that you sign. So you'll have a term sheet that says, Shahirah Co is going to borrow at 10% per annum and is going to keep the loan for 6 months. And then that reflects what the loan token says on chain. But if we were to secure that loan with like a piece of property, that's kind of how that's sort of how assets are tokenized on Maple. We tokenize the loan or we tokenize the mortgage, but we don't actually tokenize the house that is being purchased with the mortgage. So that's one way of doing it, which we think is leaner. And if you look at like, why would you do it that way? Well, you actually if you default, I want to sell the house, but selling the house, I only need to tokenize the house if I want to sell it on chain. Otherwise, I can just sell it anywhere, and I'm probably going to have a wider market of buyers off chain. And then I use that to then repay the loan. So I want to control your loan on chain, but I don't care about controlling the house on chain. The other way of doing it is the mechanism that people use is they create an LLC. Let's just use the US as an example, or I can use Australia. So we create a private limited company. So what we do then is we transfer the house into that company, and then we issue equity in that company, but we tokenize the equity. So effectively, you have a proprietary limited or PTY Ltd token on chain for this company, and the company owns the house. And so then what you say is, okay, well, whoever owns that token is the 100% shareholder of that company, and that company owns the house. So it's kind of like 2 stages removed. I think that's a bit clunky, and I think that's actually more relevant if I want to create a market for trading in houses or trading in equity or trading in some other asset class, or cars, let's say, on chain. But actually what we want to do is we want to have a capital market that trades in loans or that aggregates loans which are backed by real world assets. So I'd rather tokenize the loan and then just have the loan agreement that we use reference security that I have over your car or your house or your business or another piece of real estate.
So that's, yes, and that explains it on the I guess the lender's side. And on the borrower's side, what is the collateral? I don't know if that's a silly question. What is the collateral being put up for these loans? And compared to maybe where Maple started around the under-collateralized loan versus where you are today, what is that shift?
Yeah. it's interesting. So we started with uncollateralized loans because we entered a crowded market where over-collateralized lending was already quite saturated. So we couldn't have stepped in and priced appropriately or gained the kind of market share that we would have wanted in that product. So we entered the market with a low-cost option, kind of like, Eric Ries, like lean startup. We entered with a minimum viable product, and now over time have been able to invest more money in creating legal documents. Like there's legal research that has to go into doing, tokenized real world assets. And so then we have a secured loan agreement, and, can build out the complexity of the protocol. We did Maple V2. So it's over time we're kind of expanding. The idea has always been that we would be a generalized debt capital market that could do secured loans, unsecured loans, tokenized real world assets, kind of repo money market type stuff, which is what is happening with the cash management pool. But on the borrower side, like what are they borrowing against? Well, for the cash management pool, they own treasuries and they pledge them as collateral to borrow. So they need to like one-to-one pledge that against their loan. For another pool that we did, which is doing 10 million of loans to small businesses, which are collateralized by tax credits. So what's happening there is that small business sells its right to a tax rebate from the government, and that is audited by an accountant. It sells it to the originating company, and then what happens is the money from the government that is a rebate to that small business just goes directly to that company, and it goes into a bank account that we have security over, or that our delegate has security over. So in that instance, you have an on-chain loan, but off-chain collateral, and that off-chain collateral is the cash flows coming from the government. So the right to those cash flows. So it's like receivables finance. So that sits off-chain, but you have a full binding legal agreement that governs those obligations, and you have control, or it goes to a bank account that you have control over. So it is a mix of these types of things. What we've found in the real world asset space is that short dated, higher yielding assets are doing better, as in they're finding more people who want to fund them. And that's because if we started to do real estate loans, even shorter dated commercial ones, you're looking at 3 to 5 years, often with an option to renew it even longer. And it's really hard for us to find people who have stable coins who want to lock those up in a 3 to 5 year deal. But short dated trade receivables, they could lock it up for 30, 60, 90 days. Generally, it's going to be like 90 to 180 days. But you have this kind of, in TradFi, you've got the concept of the yield curve. Well, the on-chain yield curve steepens significantly as you get to 12 months. Beyond 12 months, the kind of yields that people require get astronomically higher to compensate them for the risk that they're bearing being a lender. And so that's why it's if you can find a 10 to 12, 10 to 13% yielding lending product that's short dated, that's kind of where you find good market fit these days.
Presumably with, I guess, this move to higher collateralized loans, the yield is lower than perhaps what it was in 2021. What sort of difference are you looking at, and what has been the response to that lower yield?
Interestingly, the market is actually highly inefficient, so it's not. So just describing the journey in the yields. So when we launched the first pool on Maple, that was May of 2021, yields on uncollateralized loans were about 15%. So like quite high. Because keep in mind, treasuries and bank accounts were yielding 0 at that stage. And so you had a spread in crypto of about 14, 15%. Even over collateralized loans then were yielding 10 to 12 or 13%. And the reason for this was that basis was really high in crypto. So basis is the forward expectation of where, the price of Bitcoin and ETH is going to be. It's the price that is paid to people it's the price that longs pay shorts in a perpetuals product, a perpetual futures product. And so that was really elevated. So that meant that you had this like very steep yield curve where people were paying high prices to access capital. So over the rest of 2021 and into 2022, yields continued to drop. And it got to the point where uncollateralized loans on stables were about 7 to 8%. So a firm the size of like a Jane Street or a Jump, like the very large market makers, are borrowing at sort of 6, 7%. That was because, like, Jane Street had publicly traded bonds that were priced around that level. So that was kind of like the best in breed yield on stablecoins. And keep in mind, treasuries are still yielding like zero then. And so what happened is then treasuries are repriced to 5.5, 6 on like 1 month. And so that's pushed up the required yields that people need. And so now if you were to do an over collateralized loan, 200%, you can still probably get 10 to 12 or 10 to 13% on it. So we're kind of back to the 2021 levels. The reason for it is that there is no supply of capital in this space. And people are now starting to reset their expectations for, what the future price of Bitcoin will be. And they're willing to take a loan collateralized by Bitcoin if they think that in future it's gonna shoot up or leg up again in another year. And so they can pay a 10 or 12% interest rate on it. They also have to, because if you can put money into treasuries and get 5.5%, at a very low counterparty risk, what do you need in order to give a loan to a company? Like, you need an extra sort of 400 or 500 basis points on that at least.
I'd like to come back to kind of future predictions on where you see the markets going. But if we just touch on, what makes an ideal asset class. You mentioned short date, high yield, highly liquid, to provide that somewhat real-time experience. What other classes fall into that, and would you be looking at? So you've mentioned T-bills, tax credits, account receivables. What sort of other ones would commonly fall in that criteria?
I'm super interested in, so we've actually been pitched and have surveyed real estate, fintechs, reinsurance, trade finance. The ones I like the most are, they have to be kind of, as I said, fit. If I'm going to source capital for it, that it needs to be higher yield, good collateral package, relatively short duration. So what I like and what I would look to develop would be like trade finance. So this could be international shipping of commodities, for example. So if you do a deal like that, you can take, 100, 200% collateralization in grain, hold it with or whatever commodity is being shipped, hold it with a collateral agent who will sell it if the counterparty defaults. You can get, 10-ish% on those kind of deals. You can deal with rated counterparties, and you can do large clips. You can do 10, 20, 25 million at a time, and it's relatively short dated. It's also much better to do that type of loan on chain, because when you do it off chain, you go through correspondent banks who can hold up the money for weeks at a time. Like, banking internationally is hugely inefficient, and that's one of the places where doing this on chain is super effective. Like, if I send USDC or USDT from one address to another overseas, it settles in a minute, settles in 30 seconds even, depending on how much gas you put into it. If you do that with between two correspondent banks, you've got T+2 to get the money from, one bank to another bank domestically. And then, it could actually be an indeterminate amount of time. Like, I've heard stories from the trade finance people that they might have an international bank actually hold up the money for weeks at a time and not process it. And so that's where anyway, we can kind of muscle in on that vertical, I think. And the other one would be fintechs. So you have a lot of fintechs now who are doing card products for startups, where they require a startup to fully collateralize a credit card. So they want a pre-funded credit card with 100K on it. They got to put down 100K in cash from their most recent Series A or Series B. And it's an interchange fee. So it could actually be a much larger than 10% yield going to the fintech who's offering that product. So I think I could lend to that fintech at like a low teens rate with full collateral protection there. and it could be relatively short dated. So that's another one that I think is pretty interesting. And again, it's a product that's born of the inefficiency of the banking system.
Mm. And how long does it take for you to create these new pools, like these new assets, and turning into these new pools and bringing it to market?
The tech lift is de minimis because we've set up, like, we've launched the protocol, so it's out there. So it's like the cost of copying a CD. So you just set up a new pool, assign a delegate to it who's going to do the underwriting and kind of oversee the pool, and then open it for deposits. And you can set it to take only whitelisted KYC deposits. You can cap the limit, so you can prevent a pool from being having too much cash that drags on the interest rate in there. But the longest part of getting a new pool launched is the commercial and legal negotiation. So it's finding a partner, negotiating commercials with them, vetting and DDing that they actually have the skills and the know-how to underwrite that segment, and then the commercial negotiation, like what do they need to be paid on it as a portion of protocol fees, and then the legal analysis. So setting up the legal documents, they'll use external counsel. So it's like that can be like let's say like an 8 to 12 week deal flow process to get like a new delegate on board. So one of the things we'll look to do is create a Maple delegate over time this year, which shortens that, because if you have an in-house delegate, then you just need to hire an appropriate credit expert to do that type of thing. So that's sort of a background project, but it is that commercial side where we found the longest delay on things.
So let's fast forward Maple 5 years from now. What does the company look like?
In 5 years, Maple is competing with, and a shift between talking about like company and protocol, because ultimately it is a protocol that operates on chain. So it would operate whether or not we are in the picture. But what I want it to do is I want Maple to compete with Ares and Apollo and to supplant them as the dominant credit asset manager globally. And so how I look at it is that those guys have credit expertise, so their core competency is structuring and raising money from pension funds, endowments, family offices. They don't actually own any tech, so their tech stack is Excel, inboxes, SQL databases, and then just buying from third-party vendors. How I view it is that Maple is currently the tech, but without the underwriting, the underwriting team or the capital raising ability. And so if we vertically integrate that and then build like a Maple delegate, and then create channels to raise capital, whether it's through the creation of like credit fund vehicles or exempt offerings, we should be able to compete with them and win deals 5 years from now, where we are either offering a lower price to a given borrower, let's say a Fortune 500 company, and achieving the same return profile, or same loan price and higher return profile to LPs, because we can operate at a lower cost, or we should be able to underprice them but offer the same kind of return to LPs who would be depositing in a pool. So that's where I think we would win business off of them. And the key thing is like the vertical integration there. Using a blockchain gives you a tech stack where it's like, we own all our bank accounts and we can send money out from them. They rent bank accounts from banks, and so they have to pay the bank for that infrastructure, and then they have to pay third parties like Plaid or other systems, software developers, to build them some software that talks to those bank accounts because they're so poorly engineered technically. Whereas that's the core advantage of doing this on chain and using smart contracts. You own the endpoints where all the money goes, and you can program how the money is routed between them. And you don't have to employ somebody to sit there and do a spreadsheet reconciliation at the end of every month of how your loan book performed and who owes which LP is owed what. And so that's the ultimate vision, is to kind of supplant them as the dominant credit asset manager globally. through vertical integration.
Amazing. Exciting times ahead, and we are running out of time, unfortunately, but I did forget to ask you one very important question around regulation and how that regulatory impact on the different kind of assets that you're handling.
Mm-hmm. So there's a couple of limbs. So you have like the regulation around lending. Lending to institutions rather than consumers is typically a less regulated in most financial markets. So you kind of that one, like there are some places where there's regulation around it, but mostly that's manageable. Whereas if you had a product that was lending to consumers, heavily regulated in every market. So on the borrower side, that is mostly like easier to manage. Where the regulation comes in is how are pools treated in different jurisdictions? How are you treated as the provider of infrastructure? So, you know, starting out and having the model of other delegates, we're kind of in this position of being software and infrastructure. And so, you know, the delegates can operate under any exemptions they choose. But broadly, there was this concept that the protocol is disaggregated and no one party is playing kind of a dominant role in making it work. As we look forward and we start to have a concept like a Maple delegate, and also as the regulatory backdrop has developed more, and you're starting to see enforcement action, you see case law building, and you're starting to see rudimentary draft legislation developing. How we look at operating in markets is going to typically be like operating under an exemption. So, for example, in the US, you have like Reg D or Reg S exemptions, and you have exemptions from operating a registered fund under the Investment Company Act. And so in the near term, until there's legislation that kind of creates a way that you can operate or a framework under which you can operate, you would do so under an exemption. And it's the same in most other markets. So Australia, you have private placement offerings for wholesale investors. Same in UK, same in Singapore, same in Hong Kong. In most markets, you have this kind of carve out for private placements to parties who are deemed sophisticated or wholesale or professional investors. And so until there's comprehensive legislation or better case law in most of those jurisdictions, you would operate under exemptions. But that allows you, the important thing is it allows you to operate in those jurisdictions. It's just a slightly higher cost to bear, and kind of caps the volumes you can do.
Mm-hmm. Yeah. Thank you for that overview, and for those listening that are perhaps on the regulatory side. We have run out of time today, Sid, but I just really wanted to thank you for really giving us a deep dive into Maple, where you've been, where you are, and where you're going. It's impressive and admirable to see you sort of steer the business over what was definitely tumultuous years, and you know, congratulations on everything you're building and on the journey so far. Wish you all the best, and you know, look forward to continuing our conversations, I guess, as Maple continues to mature.
No, thanks for having me. I really appreciate it, and loved all the questions. So thanks, Shahirah.
Thank you. Thanks everyone for listening at home. We'll catch you in your next episode. Have a great day. See you later.